The US national debt is skyrocketing, now around $36 trillion and climbing. It's a number so huge it's hard to imagine, even bigger than the entire US economy produces in a year. But what does this massive debt actually mean for you? How can a distant, abstract trillions of dollars figure possibly affect your daily life? Today, we're pulling back the curtain on the untold effects of the US debt on you, from the cash in your wallet to the future of your job, your family, and even America's standing in the world. This isn't just about politics or numbers, it's about your grocery bills, your loans, your opportunities, and our shared future. By the end of this video, you'll understand both the short-term and long-term impacts of our national debt on everyday people, including inflation, interest rates, job growth, social programs, taxes, and America's global influence. Some of these effects are happening right now, while others are looming on the horizon. So let's break it down and see why this really matters to all of us. In the short term, high government spending, fueled by debt, can make your cost of living go up. Huge federal stimulus during the pandemic helped the economy recover, but it also contributed to surging inflation, the highest in 40 years. Research from MIT shows that the overwhelming driver of the 2022 inflation spike was federal spending, not just supply chain issues. That means when you saw prices jump for gas, food, and rent, Uncle Sam's big spending on the national credit card was a major factor. In simple terms, more government dollars chasing goods can make everything pricier for you. You might have also noticed interest rates climbing on mortgages, car loans, credit cards. Why? In part because the Federal Reserve hiked rates to fight that inflation, but also because investors know the US is taking on more debt. When debt is high, lenders demand higher interest to compensate for risk. Mortgage rates in 2023-2024 jumped to levels unseen in years, making it tougher to buy a home or refinance. As federal debt grows, the government must pay more to borrow, and that pressure spills over to consumers. Higher federal borrowing can push up rates for everyone, meaning families pay more to finance houses, cars, or college. In fact, the government's own interest costs have exploded, about $892 billion in 2024 just to pay interest on the debt, more than we spend on the military and almost as much as on Medicare. That's nearly $2.6 billion drained away in interest every day. While this interest doesn't show up as a line on your bills, it quietly contributes to tightening credit and higher costs when you borrow. There is a flip side. In the immediate term, government debt spending can stimulate the economy. When Washington runs deficits, it's often to fund programs and projects that pump money into communities. Think of Social Security checks spent on groceries or infrastructure projects hiring local workers. That spending fuels business and jobs right now. During a recession or crisis, deficit spending can create jobs and support incomes, cushioning families from a downturn. So in the short run, the national debt might not feel like a shadow over your daily life. You might actually see benefits, like a new bridge in your town or relief payments during an emergency, all paid for by government borrowing. However, this short-term boost is a double-edged sword. It's a bit like using a credit card. You get the item now, jobs, benefits, stimulus, but the bill will come due later. For the moment, unemployment is low and consumer spending is steady, partly thanks to debt-funded government support. But this won't last forever, and it can sow the seeds of future problems. One immediate way the debt hits you is through political standoffs. You might recall the drama over the debt ceiling when Congress nearly defaulted on government debt in 2023, causing market jitters. These showdowns are not just DC theater. If the US ever failed to pay its bills, it could trigger a financial crisis that crashes the stock market and threatens jobs and savings. Even the brinkmanship, the close calls, has real costs. In 2023, the uncertainty led Fitch to downgrade the US credit rating, citing rising debt and political dysfunction. That downgrade is a warning sign that the world is watching our debt closely. A lower credit rating can make borrowing more expensive for the government, which again can translate into higher interest costs and lower confidence in the economy. In the short term, such episodes can rattle your 401k retirement account and raise interest rates on loans when markets get nervous. It's a stark reminder that even if you don't see the national debt, it's operating in the background, influencing economic stability right now. Over the long run, today's debt is tomorrow's taxes. At some point the government has to confront the tab it's running up. This could mean higher taxes for you and your kids in the future to pay down the debt or just cover interest payments. Experts warn that rising debt will increase the likelihood that taxes will have to go up. That might happen via new taxes or the end of tax breaks, and it shrinks your disposable income. Every dollar going to interest on the debt is a dollar that can't be spent on services or left in taxpayers' pockets. If we keep borrowing without changes, future generations may face a heavier tax burden just to fix yesterday's mistakes. And remember, inflation is another form of hidden tax. If policymakers tried to inflate away the debt by printing money, prices would surge and your purchasing power would drop, effectively charging you through higher living costs. There's no free lunch. Soaring debt makes it likely that we'll pay more, one way or another, in the years ahead. Another long-term consequence hits where it hurts. Social programs like Medicare, Medicaid, Social Security, education and more. As debt mounts, so do the interest payments required each year. The government already spends almost as much on interest as it does on Medicare, and within a few decades, interest could become the single largest item in the federal budget. Those interest costs crowd out important public investments, leaving less money for everything else. If we don't get debt under control, the nation may be forced to make painful cuts to the safety net. In fact, the current fiscal path threatens the safety net programs and the most vulnerable in society. That could mean reduced benefits or higher eligibility ages for Social Security and Medicare, fewer resources for schools and roads, or caps on welfare programs. Imagine retiring decades from now, only to find Social Security checks smaller than expected, or healthcare benefits slashed. That's a real risk when debt is unsustainable. Everyday people would feel it. Less help for seniors, fewer services for low-income families, and a thinner cushion when hard times hit. The irony is, in the short run, debt is helping fund these programs, but in the long run, it puts them in jeopardy. Perhaps the biggest hidden cost of an ever-growing national debt is a slower economy and weaker job market in the future. Here's how it works. The government is sucking up a lot of money by borrowing trillions, leaving less for businesses to borrow and invest. Economists call this crowding out private investment. Over time, that means less innovation, older equipment, and fewer new businesses, because entrepreneurs face higher borrowing costs, and investors have less capital to fund growth. Fewer investments lead to slower productivity growth, and that translates into lower wages and fewer new jobs created. In fact, analysts project that if we reduce federal debt growth, future incomes could be much higher. One estimate says income per person could be $6,300 higher by 2050 if we get debt under control. Conversely, if debt keeps rising unchecked, we're looking at a smaller economy than we could have, with diminished opportunities for every American. That could mean, when today's young people enter the workforce, there are fewer good jobs waiting, or wages are stagnant, because businesses are weighed down by interest costs and taxes. Even current workers might feel it as the decades go on. Slower growth can creep into fewer promotions, less generous raises, and a tougher time for the next generation to achieve the American dream. Simply put, a heavy debt is like a ball and chain on the economy's leg. It slows us down just when we need to sprint to remain competitive. The longer we ignore the debt, the greater the risk of a sudden financial crisis that hits everyone. Think of it like a credit card that the bank might suddenly cut off. If investors, who buy U.S. bonds, lose faith that America can manage its debt, they could demand much higher interest rates, or even stop lending to the U.S. on affordable terms. This kind of loss of confidence could trigger a chain reaction, skyrocketing interest rates, a plunging U.S. dollar, and turmoil in stock markets. For everyday people, that scenario is frightening. It could mean massive job losses, a spike in prices as the dollar's value drops, and even bank failures if U.S. bonds, normally the safest asset, suddenly tank in value. While the U.S. has never defaulted on its debt, the risk grows as debt piles up. High debt also leaves the government with less flexibility to respond to crises. If another recession or emergency happens, Washington might struggle to rescue the economy when it's already over-leveraged. It's like going into a storm with no room left on your credit limit, a very dangerous place to be. We got a small taste in recent years. As mentioned, credit rating agencies have sounded the alarm, with one downgrading U.S. debt in 2023 due to political brinkmanship and debt levels. That's a wake-up call. A full-blown crisis would hurt everyone, from Wall Street investors to Main Street workers, so preventing it by acting sooner is critical. Finally, let's zoom out to the global picture and why it matters for you. The US dollar is the world's leading currency, used in over half of global trade and 58% of world reserves. This dominance of the dollar gives America big advantages. We can borrow cheaply because others trust us, and our currency stays relatively stable. It also underpins US global leadership, but a ballooning debt threatens to chip away at that influence. As the national debt keeps climbing, investors and nations start questioning US financial strength. Confidence in the dollar could waver if they see the US not addressing its fiscal problems. If the dollar loses its top dog status, Americans could face real pain. We'd lose the exorbitant privilege of easy borrowing and could see lower economic growth, higher unemployment, and lower wealth in the long run. For instance, if countries like China, Japan, or others buy fewer US Treasury bonds, the US might have to offer higher interest rates to attract money, which again would raise borrowing costs across our economy. A weaker dollar also makes imports more expensive. Everything from electronics to clothes could cost more, hitting your wallet directly. And there's a national security angle. Being deeply in debt to foreign creditors can make the US more vulnerable on the world stage. Even a former chairman of the Joint Chiefs of Staff warned that the most significant threat to our national security is our debt. That's a bold statement, showing that unchecked debt could limit our ability to respond to global challenges or maintain military strength, indirectly affecting our safety and prosperity. In summary, the US debt isn't just a number on a balance sheet. It ties into America's power and your economic opportunities. If we want to keep our influence strong and ensure a prosperous future, tackling the debt is part of the equation. So what's the bottom line? The US national debt isn't some distant problem for future politicians to worry about. It's about you and me. In the short term, it's already influencing how much you pay at the store and the interest you pay on loans. In the long term, it could shape the kind of jobs our kids have, the taxes we pay, the benefits we rely on, and America's place in the world. If we keep ignoring it, we risk falling into a trap of higher costs, fewer opportunities, and economic turmoil. The good news? This problem is solvable, but only if we stay informed and demand action. It's up to all of us to support fiscal responsibility. That means holding our leaders accountable for smart budgeting, investing in growth, and tackling deficits before they tackle us. Share this video to spread awareness about why the national debt matters for everyone. Stay informed, talk to your representatives, and make sure they know this is a priority. By working together on solutions now, we can secure a stronger economy, protect our pocketbooks, and build a stable future. Remember, the national debt may be massive, but so is our ability as informed citizens to make a difference. Let's do our part to keep the American dream alive and well. Stay informed, stay engaged. Our future depends on it.